We're entering 2018 in an amazing environment where risk aversion seems to be very low, with valuation being at extreme levels. In art, for instance, a Da Vinci painting can be sold for circa $500 million. An environment in which cryptocurrencies like Bitcoin are valuation skyrocketing, with a valuation multiplied by 20 year to date. An environment where equity stock markets are beating records to records. Fixed income is not immune from that. Money market rates are still very negative. Sovereign rates are negative until the 5-year tenor and stay ultra low after 10-year, 20 or 30 years. Valuations seem to contrast with fundamentals. Yes, we are in a world where, in Europe particularly, GDP growth has never been so great in the last 10 years. The ECB is still buying tons of assets with the quantitative easing. Default rates in credit are going downwards and downwards year after year on the two sides of the Atlantic. In the United States of America, we have a president who has never been so pro-business for decades. This is an environment in which the Fed is starting its normalization as a policy for money market rates, but it's going to be soft, predictive, and comprehensive. It won't impact our risky asset classes. In asset-backed securities, we still like CLOs, which appear very cheap in our eyes. For plain vanilla credit, we like high beta names whose issue rating is investment grade, but at the issuance level, they can be high yield rated. We do like, in that instance, hybrid corporate names. We do like subordinated financials like additional tier 1. In another space, we still like leverage loans. Why that? They still benefit from our margin for very little sensitivity to interest rates. For investors who think that European high yield is a bit expensive, go global. You have more carry with more diversification. Last but not least, convertible bonds should benefit from positive equity market tones next year. Euro convertibles, European convertibles, or global convertibles.